Up to this point, we have used what is called a single-step income statement. So in chapters 1 through 4, whenever we put together an income statement, we put revenues at the top and all of our expenses at the bottom. And generally speaking, our expenses were in order from largest to smallest, with the exception of miscellaneous expense, which was always last. And right now, that is an example that I have right here. So that is a single-step income statement. You can see we put all of our revenues here, no matter if it had to do with sales or interest or some random stuff. We put all of our revenues up at the top. And all of our expenses are at the bottom. You can see that these are in order from largest to smallest. And we get a total for our expenses and then just our net income at the bottom. The last chapter, we looked at, can we classify our balance sheet or make categories on our balance sheet? This chapter, we're doing the same thing with the income statement. We're going to make it a little more complex. We're going to have some more classifications, but that will also make it more useful to us and to other users that need it. So this is called a multi-step income statement. Instead of a single step is revenues, expenses, one step to get to net income. Net income is revenues minus expenses. So that's the one step. Here we have multiple steps to get there. We're going to calculate a bunch of subtotals. The first thing that we need to do is separate our operating stuff from our, what doesn't actually have anything to do with our business type of stuff. And usually what's down here in the non-operating stuff or in the other revenues and expenses is interest revenue and interest expense. Unless we're a bank, interest is not what we do. So especially the interest revenue, we might be charging our customers if they pay us late, but that's not really the business we are in. Again, unless we are a bank and that's what we do. Most businesses, that's not the main thing. So we're going to put it here under non-operating. Same with interest expense. That just kind of goes with the interest revenue. This is the interest expense on loans. That also goes in the non-operating section. All right, so so all of that non-operating stuff is just going to be put here in a section at the bottom. All of our operating stuff is now going to be broken down into small categories. The first category is up here. We're going to start with our revenue. So we have our sales revenue. What did we charge our customers? How much did those goods cost us? So we subtract our cost of goods sold to get to our gross profit. And gross profit is a very important number to look at. This better be positive, or you're probably not a very good business person. Meaning that, for example, if you bought some tablets for $350, I sure hope you're selling it for more than $350. Otherwise, it is impossible to make any money. So that's what this is showing. It's also showing what is our markup on our goods. So if we bought our goods for $45,000 and sold it for $120,000, that's a pretty good markup. We're going to look at a ratio that we can use a little bit later to analyze that. All right, so once we get our revenues, our sales revenue up here and subtract our cost of goods sold, we get our subtotal of gross profit. We probably have a lot of other expenses as well associated with the business, and we're going to divide those into two categories. The first are selling expenses. This is everything to do with selling our goods. So this could be obviously advertising expense. We take out advertisements and pay for all of the social media marketing and all of that stuff so that we can sell goods. We also might have a lot of other stuff in here like wages expense. Wages expense could be, you can see up here in selling, it could also end up under administrative depending on what it actually is. We ask ourselves the question, does it have to do with selling our goods? So what kind of wages are going to go under selling expenses? It's like our salespeople. Are we paying the commissions? Are they the people staffing our stores? Or are they just the accountants in the back room? So our salespeople, the people that actually deal with our customers and are engaged in selling our products, that's going to be up here. If we have accountants or anything like that, we also might have wages down here under administrative. This example doesn't have that, but you might see examples where we have both wages under selling and administrative, because we have to break out what are the salespeople, what are the accountants and other administrative people. All right. Other things that we might have under selling. Right now we have depreciation expense listed under administrative, but we could have depreciation up here as well under selling if the depreciation relates to our stores. So that our stores have to do with selling our goods. Very hard to sell our goods if we don't have a store. So all of our store expenses are going to be under selling. We also might have rent up here if it has to do with renting out, for example, mall space. You can see we have rent expense under administrative. That would probably be for headquarters, where we have all of our executives and accountants and other analytical people that aren't engaged in selling our products. So you can see the theme here. Anything that we say has to do with selling belongs under selling expenses. And if it doesn't, we put it under administrative. So we have all of that stuff here that we can break out between selling and administrative. So you go through and you classify all of those different things between selling and administrative. You can see we have subtotals here for selling, a subtotal for administrative. Then we have total operating expenses, and then we get income from operations. That is our gross profit minus our total operating expenses. So there's another step, right? So we got our subtotal, first step, gross profit, second step, income from operations, so another subtotal there. And then we finally add in all of our other revenues and expenses to get our third step of our net income. So single step is just revenues minus expenses. Multi-step, we have several subtotals. So we have gross profit, income from operations, net income. All right, so that is our multi-step income statement. Now let's look at how we can use this to get some information out. The ratio for this chapter is the gross profit percentage. That is going to take our gross profit and divide it by our sales revenue. So we're going to say 75,000 divided by 120,000, and that equals 62.5%. So what does that mean? The 62.5% means what percentage do we get to keep if we sell our product? So if our customer gives us $1, how much of that dollar do we get to keep, and how much of it was the cost of the product? The 62.5% is our part, right? So that's what we get to keep. For every dollar that our customer gives to us, we ultimately keep 62.5 cents of it. Now, granted, we do have a lot of other expenses here that we have to cover, so this is just the cost of the product that we are looking at. What you will also see is various industries have different gross profit percentages. So you might be in what's called a low margin industry, and you might have a gross profit percentage of, let's say, 5%. So for every dollar your customer gives you, you only get to keep 5 cents of it. Now, what industries might those be? Well, guess what? Grocery stores. Grocery stores are very low margin. For every dollar of product that they sell, they might only get to keep 4 cents of it. So how do they actually make money if they get to keep so little of it? They have to sell a lot of groceries, right? So when you go through the checkout line and you're buying $100 worth of groceries, Guess what? The grocery store only keeps $4 of it. How do they stay in business? They have lots of people shopping at the grocery store. And so they make up for that low margin with volume. And so that's going to be a lot of our necessities that we have to buy. They tend to be low margin. At the opposite end of the spectrum is a high margin industry. Let's say 70%. So for every dollar that you sell, you get to keep 70 cents of it. So you're marking things up over twice what it cost you. So this would be something like you bought something for $30 and you're selling it for $100. Right? So that's a large markup. And what kind of industries are this like? Engage in this? Well, these are generally luxury items. So think jewelry. So jewelry, they don't sell a whole lot. So how do they stay in business? They have to mark things up a lot so then when they sell one item, they make a lot of money. So low margin tends to be a lot of volume so that they can stay in business. They make very little off each sale, but they sell a lot. High margin industries tend to be luxury items like jewelry, where they don't sell very much, but they make a lot off of one sale. And so that's how they stay in business.